Welcome to the deep dive. If you're keeping an eye on industrial logistics, well, we are deep in a pretty historic downturn. This freight recession has been brutal, protracted, and volume is just really hard to come by.
It really has. And today we're going to dig into the Q3 2025 earnings of, well, one of the most respected players in the sector, Old Dominion Freight Line, or ODFL.
Right.
We're pulling directly from their public filings, their conference call, really trying to answer a huge question. How does a carrier that's totally committed to being the premium, the high-cost provider, how do they survive and even invest when the economy is actively working against them?
Yeah, and the story here isn't just about, scraping by. It feels more like a high-stakes strategic gamble.
Mm-hmm.
Because right in the middle of this market crisis, ODFL is spending hundreds of millions of dollars building facilities they don't even plan on using right away.
Exactly. The core tension, the thing we're exploring, is how they manage that superior service and really disciplined pricing against this painful financial concept called the deleveraging effect.
Okay, let's hit the numbers first, the ones that really define that pain. Q3 2025.
Right. So total revenue declined 4.3% compared to last year, Q3 2024. It landed at $1.41 billion.
Okay.
And the direct result of, the soft domestic economy was that their diluted earnings per share, EPS, what they earned per share, that decreased 10.5%, dropped down to $1.28.
Oof, 10.5%. That's significant.
It was a difficult quarter, yeah. And it was entirely driven by that evaporation of volume.
Okay, let's unpack that volume problem then, because like you said, it sounds like the root of the issue.
It is.
So the key driver for that revenue drop was a massive 9.0% fall in LTL tons per day.
9%. It's huge.
And maybe just a quick reminder for listeners, LTL means less than truckload. So you're basically sharing space on a trailer. You don't have enough freight to fill the whole thing yourself.
Right, and this 9% drop, it wasn't just a couple of big customers pulling back. It reflects a 7.9% decrease in the actual number of LTL shipments per day.
Okay.
But also a 1.2% decrease in the average LTL weight per shipment.
So smaller shipments too.
Exactly. And management specifically called out that decrease in weight per shipment. They said it's generally indicative of, softness in the macroeconomic environment.
So it signals companies aren't just ordering less often, but their average order size is shrinking too.
Precisely.
But here's the part that, kind of makes you blink.
Mm-hmm.
Despite watching almost a tenth of their volume vanish,
Yeah.
ODFL refused to panic. They didn't slash prices. They're holding the line, basically sacrificing volume to protect their margins, it seems.
They absolutely are. Their LTL revenue per hundredweight, that's the key metric for yield, for pricing power, it actually increased 4.7% compared to Q3 last year. And that's excluding the volatile fuel surcharges.
Up 4.7% on price, while volume tanks 9%.
It's discipline. This approach is really a cornerstone of their long-term plan. Premium service demands a premium price, freight recession or not.
Okay, but that discipline, it has to come with a cost, right? A short-term hit to profitability.
It does, and you see it clearly in their operating ratio, the OR. That's the key measure of efficiency for carriers.
Like lower is better.
Exactly. And theirs increased 160 basis points, landing at 74.3%. So for the listener, an OR of 74.3% means for every dollar ODFL earned, 74.3 cents went toward operating costs.
So costs went up relative to revenue. Why did that relatively, modest 4.3% revenue drop cause such a comparatively large spike in the OR? 160 basis points feels like a lot for that revenue change.
That is the deleveraging effect in pure form. When your volume falls, those costs that are fixed, think about your terminal mortgages, property taxes, maybe some management salaries, those suddenly represent a much larger chunk of your income.
Okay, makes sense.
Think of it like this. If their building mortgage payment is, say, $100,000 and they run 100 shipments through it, that mortgage costs $1,000 per shipment.
Right.
But if they only run 50 shipments because volume is down, the mortgage is now $2,000 per shipment. That's the fixed cost hit showing up in the ratio.
But hang on, the sources actually say that overhead costs, the fixed part, specifically increased 160 basis points as a percent of revenue, which exactly matches the entire OR increase.
Yeah.
That seems almost too perfect. Isn't that suggesting more than just deleveraging? Doesn't that mean surgical cost control everywhere else?
It absolutely does. That's a great catch. It suggests that every dollar they could control, the variable costs, was managed perfectly. They absorbed the entire blow of that 160 basis point overhead hit without a single additional point of efficiency loss anywhere else.
Wow, okay. But the question still hangs there, right? The market's down 9% in volume, yet they raise prices 4.7%. Isn't that risky? I mean, at what point do they risk pushing crucial long-term customers away to maybe cheaper, less reliable competitors?
That's the gamble. They can only really get away with that if the service is just undeniable. It has to be. It's the absolute bedrock of their value proposition.
Okay, so let's look at the proof. What makes the service superior?
The numbers are frankly incredible for this industry. In Q3, they delivered 99% on-time service.
99% on time.
And get this, a cargo claims ratio of just 0.1%.
0.1%. That's almost unheard of, isn't it?
It really is. To give you some perspective, the industry average for many public LTL carriers can be 5, maybe even 10 times that rate. So this kind of service, it guarantees reliability, it minimizes inventory risk for shippers. That's the value.
And the industry clearly sees it too. You mentioned external validation.
Yeah, they were named the #1 national LTL provider for the 16th consecutive year by Mastio and Company. They finished first in 23 out of 28 service and value attributes they evaluated. 16 years running.
Okay, so the service premium is real and recognized. What about controlling those costs we talked about?
Right.
The variable ones.
Right. What's equally fascinating is how they managed what they could control. While fixed costs, as we saw, were kind of devastating from a ratio perspective,
Yeah.
their direct operating expenses, those are the variable costs, like driver wages, fuel, line haul costs, those were actually flat as a percentage of revenue compared to Q3 last year.
Flat. Even with volumes down, that's impressive cost management.
It gets better. Their direct variable costs were reported as relatively consistent as a percent of revenue compared to when they achieved record operating results back in 2022.
Wait, consistent with 2022, when freight density was super high. How are they maintaining 2022 level variable efficiency when they're running, presumably, much emptier trucks?
Yeah, it's about technology, optimization, and just constant refinement. They've implemented new workforce planning tools, dockyard management systems, basically ensuring docks aren't overstaffed when volume is low.
Smart.
They're using P&D, that's pickup and delivery, and line haul route optimization software. And this isn't just basic scheduling, it's about dynamically reducing wasted miles, empty miles.
Can you give us a specific example? How does this tech actually translate to savings on the ground?
Absolutely. So they're actively researching using AI for automated line haul plan creation.
Okay, AI. Buzzword alert.
Mm.
Or real impact.
No, this is real potential impact. It means maximizing the cubic capacity used on every single trailer and cutting down those empty miles between terminals. In an LTL network, an empty mile is just pure lost profit. It's a huge cost driver.
Got it.
They're also analyzing video from LIDICS cameras, those capture dock activity, using that for driver coaching, continuous process improvement. And they're implementing billing automation to reduce back office labor costs. It's about squeezing out every single ounce of operational efficiency they can find to defend that OR.
This whole picture, the discipline, the tech, the long-term focus, it brings us back to the core of their strategic gamble capacity. If they're losing volume now and managing costs tightly, they're still making this massive long-term bet on the future, aren't they?
They absolutely are. Their typical target, is to have about 20% to 25% excess terminal capacity available, just sitting there, ready for market growth.
It's like a buffer.
Exactly. But the source material, the conference call, indicates they're currently well north of 30% and probably even above a 35% type of range.
35% excess capacity. Wow.
They are consciously building a huge capacity buffer, betting heavily on the timing and strength of the eventual upswing.
And taking some strategic short-term pain to secure that future position. You mentioned they have several completed service centers held in ready reserve.
Yeah, facilities they've finished building but haven't actually opened or started operating yet.
Why do that? Why build it and not use it?
They're keeping them dark on purpose right now. The reason is to avoid weakening their network density further in this low-volume environment. Opening them now would likely drive their line haul expenses up even more.
So they're taking the financial hit today, the cost of those buildings sitting idle in preparation for tomorrow's rebound.
Precisely. And crucially, that incremental depreciation expense from these mothballed facilities, it's already hitting their numbers. It contributed to a 70 basis point increase in depreciation cost as a percent of revenue in Q3. That cost is already baked in.
That is a staggering commitment. I mean, capital expenditures for just the first 9 months of 2025 totaled $369.3 million.
And the full-year CapEx is expected to be around $450 million. That breaks down to about $210 million for real estate and $190 million for equipment. big spending in a downturn.
But they seem to have the financial strength to pull it off.
Oh, definitely. Cash flow from operations was strong, $437.5 million just for Q3. And while they are investing heavily in capacity, they're also returning cash to shareholders. They used over $600 million, specifically $605.4 million, for share repurchases in the first 9 months of 2025.
So they have the financial muscle to actually execute this capacity gamble.
They certainly do.
Okay, now let's pivot to the future. Everyone in freight is waiting for that inflection point, right? The turn. What are the current demand signals telling us? Is it getting closer?
Unfortunately, the preliminary data they shared for October 2025 showed continued softening. Revenue per day was down somewhere between 6.5% and 7% year over year.
Still down. And tonnage?
LTL tons per day was down 11.6% in October, so the volume decline actually accelerated a bit from Q3.
Ouch. And what about sequential trends, like month over month? Sometimes that tells a different story.
Yeah, you'd hope so, but October tonnage actually dropped 5% compared to September.
Okay. Is that normal seasonality?
Not really.
Yeah.
That's the key metric here showing continued weakness. Historically, the 10-year average sequential decrease from September to October is only about 3%. So dropping 5% means demand is actively underperforming normal seasonality.
So the environment seems to be deteriorating still, not even stabilizing yet.
That's what the October data suggests, yeah.
And given this uncertainty, management gave a sort of cautious, maybe higher than normal Q4 operating ratio forecast.
They did. They anticipate a sequential increase, meaning from Q3 to Q4, of about 300 basis points in the OR. The range they gave was 250 to 350 basis points.
And how does that compare historically?
Well, that range is definitely higher than the historical norm for Q4, which is usually around a 200 to 250 basis point increase. And they explicitly tied that higher forecast to the revenue uncertainty.
Makes sense. When they were asked, what's delaying this inflection point, what did management point to?
Mostly macro factors. They mentioned the ISM manufacturing index being below 50, which indicates contraction for 32 of the last 35 months. That's a long stretch.
Wow.
They basically believe clarity is needed on big picture things like the trade loop, specifically tariffs and maybe corporate taxes, before their customers really get excited about growth and start restocking inventories again.
We're also seeing some interesting shifts in the actual freight mix that seem to reflect this environment. The average length of haul dropped 1.5% in Q3. What's driving that?
It seems to be two things. First, just a continuation of regionalism in their network. They mentioned next day and second day lanes now make up 70% of their revenue. That naturally shortens the average haul. But second, it also suggests that when shippers have more time in their supply chain, which they do right now because inventories are generally pretty full, they're using that time, they consolidate longer haul freight and maybe opt for cheaper modes like intermodal rail or maybe brokered truckload, avoiding premium LTL for those really long distances.
Interesting. Using time as a buffer to find savings.
Exactly.
But despite all this current pain and uncertainty, management still sounds pretty bullish on the long-term competitive landscape, especially for when the market does finally turn.
Oh, definitely. They strongly believe that when the market finally inflects, it will be even more capacity constrained than it was back in the boom times of 2022.
More constrained. Why? Didn't the Yellow bankruptcy free up terminals?
Well, that's the interesting part. Their view is that the massive volume shakeup from Yellow's collapse didn't actually fill the existing service centers of the other public carriers as much as people thought. They believe many of those Yellow terminals were either sold to non-LTL players, maybe private equity, or simply remain unsold, underutilized. The net effect, in their view, is less effective LTL capacity overall when the demand surge finally comes.
So, okay, let's try to synthesize this for the listener. What does this all mean? It feels like the crystallization of a really high-stakes bet. ODFL is executing this full-scale, long-term defense strategy.
That's a good way to put it. They are absolutely maintaining price discipline. Remember that 4.7% yield gain, and showing superior cost control, especially on the variable side, keeping it consistent with 2022 levels.
Right.
But they're deliberately sacrificing volume in the short term, that 9.0% tonnage drop, in order to accumulate this vast excess capacity, which is now sitting well over 75%.
So the whole strategy is just a massive confident bet that the market inflection, whenever it happens, is going to be quick and strong.
Pretty much, they're positioning for that snapback.
Okay, so here's a final thought for you, the listener, to chew on. The company has invested over $2 billion just in the last 3 years to expand capacity and maintain that top-tier service, all during this deep slump. with capacity utilization potentially dipping below 65%, meaning over 35% is idle.
Yeah.
What financial breaking point, if any, exists for a strategy like this? One that prizes readiness and service quality above chasing short-term volume, especially if this freight recession drags on, say, deep into 2026.
That really is the multi-billion-dollar question, isn't it? It separates the leaders from the laggards. They are positioning themselves, banking on the idea that they'll be maybe the only carrier capable of handling a huge surge in volume immediately when it comes.
Which would let them gain profitable market share very quickly.
Exactly. Faster than anyone else can react or bring capacity online.
So what does that imply for the competitive landscape when the market does finally recover?
Well, it suggests maybe a permanent shift in market share towards the carriers who were bold enough and financially strong enough to invest when everyone else was forced to cut back.
A fascinating strategy to watch unfold. That's all the time we have for this deep dive. We hope you have some actionable takeaways about managing a premium business in, well, a deeply challenging environment.
Absolutely. Until next time, keep thinking critically about where those capacity constraints will really bite when things turn around.